Most people think the dollar is strong because America says it is. I have never trusted a monetary system that much. Real strength is not a slogan. Real strength is a machine. It is a system of habits, incentives, trade flows, military arrangements, reserve behavior, and international dependence, so deeply embedded that the world keeps feeding it without being asked twice. That is what made the dollar extraordinary. And that is exactly why this moment matters so much. Because once the machine begins to crack, the crack does not announce itself like a movie scene. It shows up first in behavior. A country leaves, a contract shifts, a reserve manager buys something else. A central bank stops trusting paper promises the way it used to. A commodity trade settles in a new currency. A buyer and seller quietly decide they no longer need the old route. That is how reserve systems weaken. Not all at once, piece by piece. That is the mother line. For this whole story, the dollar is not mainly threatened by speeches. It is threatened by changed behavior. And once behavior begins changing at scale, the world that used to look permanent starts looking much more like an arrangement with an expiration process. I want to begin where the real story begins. Oil, not because oil is everything, because oil sits close enough to everything that it changes the shape of money itself. People talk about the petrodollar like it is either a conspiracy theory or a magic incantation. It is neither. It was a strategic arrangement, a brutally effective one. And for decades, it helped hold up the most important monetary advantage any nation has ever enjoyed. After the early 1970s oil shock, America needed more than diplomacy. It needed a new monetary spine. The old Bretton Woods structure had cracked. Gold convertibility was gone. The dollar needed a new anchor, not in metal this time, but in necessity. And there are few necessities on earth more powerful than energy. So the arrangement emerged. Major oil producers, especially in the Gulf, priced oil in dollars. The world needed oil, so the world needed dollars. Countries bought dollars to buy energy. Producers received those dollars and recycled a large portion of them back into dollar assets, especially U.S. debt. America provided security, support, weapons, diplomacy, and access. The machine fed itself. That was the genius, not moral genius. Structural genius if the world had to buy oil in dollars. Then the world had to maintain a permanent demand for dollars, whether it liked America or not. And if oil exporters kept shoving a meaningful amount of their surplus back into U.S. debt, then America could run a very unusual kind of empire. It could import, consume, borrow, and finance itself on terms other countries could only envy. That is what economists politely call exorbitant privilege. I prefer blunter language. It was a cheat code, not because America was invincible, because America found a way to tie the world as most indispensable commodity to its own paper. That is what made the dollar bigger than a currency. It became the toll road of global energy. Now, if you understand that, then you also understand why the current changes matter so much. The machine does not have to fully disappear to become weaker. It only has to become less automatic. And that is exactly what is happening when the UAE steps away from OPEC discipline and openly pursues more independent production and alignment. It is not just an oil story, it is a sovereignty story. When Gulf states talk more comfortably with BRIC structures, it is not just a diplomatic story, it is a settlement story. When Saudi Arabia negotiates with China more seriously on long-dated energy relationships, it is not just trade, it is a signal. When India pays for some energy in rupees and Russia settles outside the old Western channels, it is not yet the end of the dollar, but it is evidence that the old monopoly has been replaced by experimentation. Experimentation is how monopolies begin to die. The dollar does not need to vanish for America to feel pain. It only needs to lose its exclusivity. That is the point most people still do not grasp. They keep arguing as if the question is whether the dollar goes to zero. That is childish. Nothing serious is measured that way. The real question is far simpler and much more dangerous. Is the dollar becoming less necessary at the margin? Because if the answer is yes, then the implications are enormous. Less forced demand for dollars, less automatic recycling into treasuries, less obedient financing of U.S. deficits, less tolerance for paper promises, more room for alternatives, more pricing power for real assets. That is the shift. And the most intelligent institutions in the world are already acting like they know it. This is where gold enters the story. People love mocking gold because they do not understand what role it plays. They think gold people are always predicting the end of the world. Sometimes they are fine. I am not here to defend every gold bug with a bunker and a megaphone. I am here to talk about incentives. Central banks are buying gold at a pace we have not seen in modern history. That is not a meme. That is not fringe. That is not survivalist fantasy. That is official behavior by the people who manage national balance sheets. And central banks do not buy gold because they want fashion. They buy gold because gold sits outside the promise structure. No one can print it, no one can sanction it with a keyboard, the same way they can freeze reserves held in a foreign banking system. No one can dilute it by running another deficit. No one can default on it because it is not someone else's liability. That is why the gold buying matters so much. It is not a price story first. It is a trust story. Once Russian reserves were frozen, every serious reserve manager on earth learned the same lesson at the same time. If your national savings sit inside someone else's legal system, then in a moment of conflict, those savings may not be your savings anymore. That changes behavior very quickly. And once behavior changes, gold becomes much more than a shiny metal in a vault. It becomes neutral collateral in a world that is becoming less neutral. That is why I like the 3Ds here: de-dollarization, debasement, diversification. The first is obvious. Now more countries are exploring trade outside the dollar, especially in energy. The second matters just as much. America keeps running deficits so large that anyone holding long-term faith in paper dollars must eventually ask a humiliating question. How much more supply of this unit can the system produce before every existing unit quietly loses more purchasing power? That is debasement, not necessarily through a dramatic collapse, but through slow dilution. Chronic borrowing and a political structure too addicted to spending to behave like a creditor nation. The third is what every prudent reserve manager does when the first two appear. Diversify, not out of drama, out of self-respect. That is exactly why gold keeps appearing. Not because central banks are nostalgic, because gold is one of the few reserve assets that does not require trust in the fiscal honesty of another government. That matters more now than at any point in decades. And this is where the ordinary investor usually gets the story wrong. He thinks the gold move is about inflation alone. Too small. He thinks it is about fear alone. Too emotional. He thinks it is about apocalypse. Too cinematic. The real story is structural. When the monetary architecture of the last 50 years begins to lose exclusivity, institutions start looking for reserve assets and monetary hedges that do not depend on one state remaining permanently benevolent, permanently solvent, and permanently central. That is why gold moves before the textbooks are updated. It is sniffing out a change in the plumbing. Now let me say something that may sound strange coming from me. The dollar is not disappearing tomorrow. I do not deal in cartoon endings. America still has the deepest capital markets in the world. America still has military reach. America still has the world's most powerful equity market, still pulls in global capital, still dominates financial infrastructure in ways that are hard to replace quickly. That is all true. But permanent monopoly is different from dominant incumbency. The first is over. The second may last a long time. That is the nuance. And nuance matters because many people hear petrodollar weakening and immediately jump to extremes. Either the dollar is fine forever or the dollar is dead tomorrow. No serious investor should think that way. Serious investors ask a better question: who loses first if the old machine weakens gradually? And who benefits? The loser is the person overexposed to the assumption that dollar privilege continues untouched. The loser is the saver in idle paper who thinks nominal stability is safety. The loser is the nation whose debt habits were built on endless external appetite for its bonds. The loser is the investor who mistakes old prestige for permanent demand. The beneficiary is the owner of scarce real assets. The beneficiary is the holder of gold and perhaps silver as monetary hedges. The beneficiary is the investor who understands that reserve diversification by central banks is not a one-week trade but a long-duration signal. The beneficiary is the person who sees that when money becomes less trusted, hard assets re-rate long before the public fully understands why. That is why I think about this through asymmetry. The downside of pretending nothing changed is very large. The upside of acknowledging the shift early is also very large. And this is where portfolio construction becomes more important than ideology. I am not interested in worshiping gold like a religion. I am interested in using it for what it is: a monetary hedge, a trust hedge, a reserve, asset alternative in a world where paper claims are becoming more political. That is a very different posture from fanaticism. A person can own physical gold if he wants direct possession. He can own liquid ETFs if he wants simplicity. He can look at miners if he wants operational leverage to the metal. Though that comes with a very different risk profile because a miner is still a business with management, costs, jurisdiction risk, and execution risk. These are not the same thing. Again, structure matters. Physical gold is not the same as paper gold. Paper gold is not the same as miners. Miners are not the same as royalty companies. I would think about each one differently, but the deeper point remains the same. The move in gold is not random. It is not just fear. It is the market response to a monetary architecture that is no longer as exclusive, trusted, or unchallenged as it once was. Now, what about oil itself that matters too? If the old petrodollar machine weakens, energy producers gain more bargaining room, buyers gain more settlement options. Regional blocs gain more autonomy. The world becomes more fragmented, less frictionless, and less obedient to one unit of account. That fragmentation is bad for the old reserve monopoly and often good for the kinds of real assets and resource exposures that sit closer to physical necessity. Again, not because everything breaks, because everything gets repriced. That is what investors need to understand. Reserve shifts do not need to create chaos to create opportunity. They only need to change the direction of flows. And flows are what move price. I have always believed that the smartest money in the world does not wait for the headline. Everyone agrees on. It watches what the big institutions do when nobody is forcing them to explain themselves yet. Central banks buying gold in size, oil producers experimenting with settlement outside the dollar, treasury holdings shifting, reserve managers broadening their options. Those are not opinions, those are footprints, and footprints matter more than speeches. So if I were translating this whole source document into one hard Buffett-style truth, it would sound like this. America's advantage was never just that the dollar was powerful. It was that the world had to keep using it in the most important commodity market on earth and then kept sending those dollars back home to finance America's successes. If that loop weakens, even gradually, then the dollar does not need to collapse for the old privilege to shrink. It only needs to become less compulsory. And the moment that happens, gold stops being old-fashioned and starts looking like what it really has been all along. A neutral asset waiting patiently for paper empires to overestimate how permanent they are. That is why gold knows, not because gold is magical, because gold responds when trust shifts, and trust is shifting now. The average investor will notice late because the average investor always waits for permission from the headline after the move. But the institutions are already telling you what matters. They are buying neutrality, they are buying insurance, they are buying distance from one system. You do not need to become a prophet to learn from that. You only need to become less naive. The petrodollar machine is not finished in the dramatic sense, but it is no longer unchallenged. And once something that powerful loses the habit of being obeyed automatically, the repricing can last far longer than the crowd thinks. That is the real lesson. Not that the dollar goes to zero, that the old loop that made it untouchable has begun to loosen. And when that loop loosens, the smart money does not wait around asking whether the emperor still looks impressive. It starts buying what still holds value when empires begin renegotiating the terms of their privilege.